This morning, silver did something that simply does not happen in a normal market. In the span of roughly half an hour, price collapsed by about $15, falling from around $121 down to nearly $106. That's a move of roughly 15% in minutes. But here's where the story flips completely upside down. By the time I'm recording this, silver has already recovered. Not just recovered, it has turned green on the day. Let that sink in. After being slammed $15 in about 30 minutes, silver is back above $117 and positive on the session. That is not typical price behavior. That's not healthy consolidation. That's not even a routine liquidation spike. What we are watching looks like the physical market overpowering the paper market, a S ability to control price in real time. The mechanism that used to pin silver down is glitching because the moment paper pushes price lower, real buyers step in and erase the move. And that is what makes today unprecedented. It's not just the crash, it's the recovery, it's the timing. And it is the widening gap between East and West that is screaming something much bigger is happening beneath the surface. The most important data point in this entire story is coming out of Shanghai. On the Shanghai Futures Exchange, silver is trading around 31,620 yuan per kilo. When you convert that into per ounce pricing, it comes out to roughly $141 per ounce. Let that settle. Shanghai is signaling around $141 per ounce, while the Western paper benchmark on COMEX has silver sitting around 116 to 117. That gap is not small. It is not noise. It is not a minor regional difference. It is massive. Right now, the implied Shanghai premium is roughly $25 per ounce, and a $25 premium is not a normal market condition. That's not what you see when everything is flowing smoothly. A premium like this is a flashing warning sign. It tells you metal is more wanted there than here. Physical supply is tighter there than here. And this matters, the Western paper price is no longer reflecting physical reality. In past cycles, a smash like this, $15 down in minutes, would have triggered a familiar chain reaction. Paper dumping would hit the market, stops would get triggered, weak hands would panic sell, momentum would break, and follow-through selling would continue for days or weeks. The rally would die. That was the old playbook. But today, that playbook looks dead, because the moment the paper dump finished, price didn't keep falling. It snapped back, and the recovery was fast, almost mechanical, like someone had a checklist. If it drops, buy it. If it drops harder, buy more. If they try to break momentum, absorb it. That kind of response doesn't come from retail panic buyers. It looks like systematic physical demand stepping in again and again. Let's map the day the way the market actually lived it. Around 9:15 in the morning, silver was trading near $121. By 10:29, it was down near 106. Later in the session, it was back around 117. A $15 collapse followed by a violent rebound. Zoom out and it becomes even more extreme. For years, silver was stuck in a slow, boring range between $20 and $30, where a big move was 50 cents. Now we're talking about $15 swings in a single day. That tells you the market has entered a different phase. Price discovery is breaking down. Leverage is stacked too high, and the tug-of-war between paper selling and physical demand has become so intense that price is behaving like it is trading in two markets at once. Here is the pattern you cannot ignore. U.S. trading hours dump paper. Asian trading hours buy metal. Look closely at when the selling happens. Nearly all the heavy selling shows up during U.S. market hours when New York is open and the paper trade is most active. Then Asia wakes up, physical demand hits the tape, and price starts recovering. So the rhythm becomes simple. New York opens and paper gets dumped. Asia trades, and physical demand reclaims the price. Repeat. That pattern is the tell. It suggests the West is trading derivatives and exposure while the East is absorbing real supply. And when real buying pressure becomes strong enough, it eventually drags the paper price with it, whether the paper system wants to follow or not. Now imagine you'd are a bullion bank sitting on a massive short position, hundreds of millions of ounces. If price rises, your position bleeds. So you do what the system has always done. You launch a raid. And this week, we have seen what looked like two separate $50 raids. And after both of them, silver is still back above $117. In the old regime, that kind of raid would have shattered confidence and triggered follow-through selling. Today, it is getting absorbed like a sponge. That implies something deeply uncomfortable for the paper side. They can still push price down, but they can't keep it down. If Shanghai is effectively paying a $25 premium, and that premium is growing by $2 to $5 per day, that is not stable. Markets can tolerate spreads when flows are smooth. But when spreads widen like this, one of two things happens. Either Western paper prices rise to meet physical reality, or physical metal stops flowing west. If metal is being pulled east at higher premiums, supply gets diverted. And if Western vaults can't source enough metal to meet physical requests, the credibility of the benchmark begins to fracture. And once credibility cracks, it doesn't collapse slowly. It collapses suddenly, because trust is the only thing holding it together. That's why the Shanghai premium isn't just a statistic. It's a regime signal. It is the market telling you the center of gravity is shifting and the plumbing is seizing up. Now connect this to what's happening in the real world. First, refineries begin to clog. Backlogs form, turnaround times slow, and some facilities temporarily stop accepting new metal because they cannot process it fast enough. Second, the retail market snaps. Local coin shops halt purchases, not because demand is weak, but because capital tightens and turnaround times stretch too far. When prices swing violently and supply chains jam, dealers cannot comfortably make two-way markets. Third, reports emerge that a major government mint may be shutting down silver sales within roughly 24 hours. Think about that sequence. Refineries jam, coin shops pause. Government mints restrict or stop sales. That is not normal volatility. That is the system straining under demand, with the bottleneck moving from one node to the next like falling dominoes. And here's the wild part. If those reports are accurate, the market is already showing pre-squeeze behavior before the real short squeeze even begins. This looks like the prelude, the warm-up, the plumbing warning. Because the moment a widespread physical shortage becomes obvious, the moment the public notices and tries to source metal at scale, the paper system gets tested where it is weakest, delivery and credibility. So, what actually triggered this morning's crash? It wasn't just one thing. It was multiple forces stacking on top of each other. First, excessive leverage. Traders have been running extreme leverage, 50 times, 100 times, especially in futures and short-dated options. When price turns against that kind of leverage, the market doesn't move smoothly. It falls through trapdoors. The first drop triggers margin calls. Margin calls force liquidations. Liquidations push price lower. Lower prices trigger more margin calls. It becomes a cascade. Second, profit-taking after parabolic gains. When assets go vertical, people lock in profits. Gold has been massively higher over the past couple of years, and silver has moved even faster. That creates natural pressure to take chips off the table. When that pressure collides with extreme leverage, the result isn't a gentle pullback. It's a violent flush. That does not mean the bull market is over. It means people don't want to round-trip profits after a historic run. After a move like this, locking in gains isn't bearish. It's rational. Third, broader risk-off selling across markets. When stocks sell off hard, especially large tech names, funds de-risk. During those waves, even so-called safe assets get sold because liquidity becomes the priority. Traders sell winners to cover losses elsewhere or to raise cash quickly. And finally, extreme overbought conditions added fuel to the move. When indicators stretch to historic extremes, markets do what they always do. They flush weak hands. It's classic behavior. The more extended the move, the more violent the shakeout. The goal isn't to kill the trend. The goal is to reset positioning. And that leads to the fifth factor behind this move. There was no single headline catalyst, no sudden war headline, no surprise policy announcement, no central bank shock in that exact minute. What happened was purely the market's internal mechanics at work: positioning, leverage, stops, and liquidation, all doing what they always do when the spring gets wound too tight. All 5 factors were real. Every single one of them applied. But here's the mid-video reveal that actually matters. All 5 bearish forces hit at the same time, and silver still recovered and finished green on the day. That tells you something powerful. The paper market threw maximum pressure at price discovery, and it got absorbed. That is a giant billboard advertising underlying physical demand. And it wasn't just silver. Gold itself dumped hard intraday, wiping out a massive amount of market value in a very short window, and then rebounded sharply. When a gigantic asset like gold starts behaving like a meme coin, it tells you something is fragile beneath the surface. It tells you leverage is high. It tells you liquidity is thinner than it looks. And it tells you derivatives are dominating price action. When derivatives dominate, the market becomes reflexive. Positioning moves price. Price triggers liquidation. Liquidation moves price again. That feedback loop is exactly why volatility is exploding right now. It's not just more buyers, it's more leverage. Now look at what the banks are saying. There has been a clear messaging shift. Big banks keep hiking gold price targets. The exact numbers matter less than the direction and the speed of the revisions. When targets keep getting raised again and again, it usually means the forces driving price are stronger than expected. Central bank buying, safe haven flows, bond market stress, and investor allocation changes. Allocation is one of the most misunderstood forces in markets. When massive pools of capital shift allocation even slightly, from 3% to 4.5% or a bit higher. It doesn't sound dramatic until you do the math across global portfolios. That's how you get enormous capital flows. And silver, because it's a much smaller market with heavy industrial demand, reacts more violently. Bigger upside moves, bigger downside swings. That's the opportunity, and that's the danger. Now let's be honest about the bearish case, because ignoring risk is how people get destroyed. If you're trading on margin, running futures, short-dated options, or anything where a $10 or $15 move can force liquidation, this market is a minefield. In this environment, your thesis can be right, your direction can be right, your timing can be right. You can still get liquidated before the move plays out. That's the brutal reality of leverage. And if equities continue selling off hard, panic can trigger forced liquidation across all assets. In those moments, people sell what they can, not what they want. History shows this clearly in 2008 and again in March 2020. Even metals can temporarily drop alongside stocks, despite being structurally bullish. So yes, the bearish risk is real, especially for traders and leveraged paper positions. But here's the key distinction. Those risks do not erase the structural setup for physical holders, because every physical data point is flashing deficit behavior. Shanghai premiums near $25, strong physical pull from Asia, refineries backing up, coin shops pausing purchases, mint shutdown rumors, and 2 major price raids already absorbed and reversed. And then there's the most shocking data point of all. Silver can crash 15% intraday and still finish green. That is not how a weak market behaves. So where does this leave us? 3 takeaways. First, the old paper dump playbook is failing. A $15 smash used to break momentum for weeks. Now it can't even keep price down for a full session. Physical demand is absorbing the raids. Second, the system is breaking in sequence. Refineries jam, coin shops halt, mints restrict. That is the plumbing seizing up under demand pressure, and it suggests the real squeeze may still be ahead. Third, the regime shift is being acknowledged in real time. Targets and narratives are moving higher because the fundamental drivers, allocation flows, safe haven demand, central bank behavior, and physical tightness, are pushing the market into a new zone. And that leaves us with the unresolved tension hanging over everything. How long can a $25 Shanghai premium survive before the Western pricing system loses credibility? How many more raids can happen before the market fully realizes the paper side can push price down to wow, but cannot keep it there? And what happens when the physical squeeze in the plumbing finally collides with the derivative market and forces mass short covering? We are watching the shift from paper dominance to physical dominance in real time. The moves will stay violent. The swings will stay brutal. If you're trading leverage, this market can wipe you out in minutes. But if you're thinking long-term, focused on structure, supply chains, and premiums, what you may be witnessing right now is the shakeout before the next phase. Do your own due diligence, know your risk tolerance, and don't confuse hype with strategy.